Hello, everybody. I'm your boss, Joe Boss, and welcome to another Daily Plan. We had quite a surprise today, kind of across the board, on so many assets, because we got an insane move out of the manufacturing PMIs. Real quick. Yeah, data compiled by ISM showed that prices for service providers and on the manufacturing side performed well, and the services side came out and those performed well. Also, employment numbers from ADP, those performed well. And by specifically on the services side, when I say it performed well, I mean you're starting to see some letdown on it. Services are not maintaining such a strong pace where it's going to keep the Fed essentially on hold indefinitely as the service sector continues getting stronger and stronger and has some more inflationary pressures to it, right? The service sector includes housing, it includes financial services. I mean, housing is kind of the big one, to be frank. And to at least see the services side of these PMIs start to come down, it's looking real good. It's looking real good. But the fight isn't over quite yet. We are still kind of in the thick of it. Just because we get one moderately slowing down, you could say ISM, PMI for services, we got to be careful to get too excited about it. It's a great response. It's great data. But I am on kind of the back foot here right now. So this is Chris Williamson from S&P Global. There are two sets of PMIs. There's ISM, the Institute of Supply Management, and then S&P Global, which then acquired the IHS PMIs. So there are two institutions that release PMIs. And to be frank, I don't really trust the ISM PMIs to do much. They're not as strongly correlated as the S&P PMIs because they are a much smaller sample. Remember, ISMs and PMI, all these PMI numbers, they are all surveys of purchasing managers from service and manufacturing industries. They're surveys. And the ISM just is a much smaller survey. It's not as accurate. Now, the main thing I want to kind of bring our attention to when it comes down to these PMIs is the difference between the reported price changes in the PMI. So why did, for example, the ISM services PMI jump, but not the S&P PMIs? Let's see. Where is it? Order inventory, order output, feature output expectations that are 10-month high. Man, with all these tabs, you think I'd be a little bit more prepared. Good thing I actually wrote down what I wanted in the economics channel here in Discord. Yeah. Okay, I'm just gonna read it out here. So for the ISM, I'm gonna copy it over here onto the chart. So from the ISM PMIs, right here where it says price pressures eased to 53.4 over versus 58.6 in the last one. This is what moved the headline number in those ISMs so much on the services side. This is what moved it on the ISM. Everything else, yeah, might have moved up or down a little bit, but it's this price pressures subcomponent that went to the lowest since March of 2020, so essentially since COVID. But respondents indicated that even with some prices stabilizing, inflation is still a concern. And then compare this to the S&P Global Services PMI and what they said. On the price front, higher wages continue to underpin input costs, inflation, but with rises in transportation and material costs and triggering a sharp increase in output charges. Guys, I get that this looks good at face value. Right now, this all looks very hunky-dory, right? If we go to the DXY, like, oh my god, we're meeting our nominal expectations now, you know, right? This is our nominal trade plan. I would say this has been a funky week because you had a really good US PMI come out, and now you have a more soft PMI coming out. But this isn't the end of the world here for the US dollar, to be frank. Just like it wasn't the end of every risk on trade over here. I mean, guys, look at gold. You think every risk on trade is kind of not in play here? There was actually something right here. Yeah. Gold extends 7-day rally to record highs. Gold surged towards $2,300 an ounce. Yep. ADP employment report exceeded expectations. Private businesses adding 184,000 new jobs. Additionally, gold prices have surged over 11%, supporting the safe haven aspect of it amid escalating geopolitical tensions. Da 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 da. Everything looks, you know, depending on the chart you're looking at, things are behaving quite idiosyncratically. If I were to go to Eurodollar real quick, this looks like gangbusters, right? This is like the reverse of that DXY chart, right? Well, to be truthful, I'm looking at these yield spreads and I'm like, oh no, this is still really bad. So while it sucks, I did get a short trade right here, and I have my short trade here. I'm out of this one. I'm still in this one because these yield spreads are super negative. Like, look at all this red here on these yield spreads. So if we, real quick, check out what the negative yield spread looked like throughout time, see how it's kind of changed. All right, so it got to negative 1.6, call it 7 there. And right here it's at negative 0.9. And right now on today, it's at negative 1.1, call it 5. So the yield spreads are still negative and they're still holding up relatively their value around here. If those PMIs, if specifically if the ISM PMI did not spike the way that it did because of the prices paid component in there, we would not have had this sort of move across pretty much all of these major assets that made the dollar jump like this would not have happened if that prices paid component in the ISM services did not spike. So everything hinges on that number actually being accurate. And I already stated I am not a firm believer in the accuracy of the ISM numbers over the S&P Global PMIs. Yeah, I bet Powell was dovish today because he's starting to see this improvement on the ADP, which is really good to see. But you also need to see non-farm payrolls improve too, right? Like you said, right? Non-farm payrolls can be dollar bullish. It's really going to depend. One of the reasons why employment actually is performing quite well at the moment. Check this out. So this is Federal Reserve Bank of Chicago National Financial Conditions Index. And if you look at the adjusted version, which is kind of the more realistic option of the two, if I could zoom in here real quick. So see this line, it's going down. The lower this goes, the looser financial conditions are. So back in January, financial conditions were quite loose, and now they're still quite loose. They got a bit tight over here in February, and now they're getting loose again. And the hope is that we're going to continue to see these financial conditions get even looser going forward. And then that's going to allow more people to borrow more money. But we have a few problems with the looser financial conditions. Specifically, if I could find, what is it? Is this the one? Yeah, that's copper. And that's oil. Commodity prices are going through the roof right now. Oh, and then that's Disney. We'll check that out in. Let's see here. Did I? Yeah, this is a review for March CPI. We'll go over that now, actually. And we got Sarah House and Ombre George. March CPI report will be a key indication of whether we see a pickup in inflation. Those upticks in commodity prices, cocoa price hits $10,000 a ton. Everyone is freaking out in cocoa.
Well, we want to talk a little bit about what's happening.
Nope, I don't really want to listen to you. There we go. Copper hit an 11-month high this week. So if I go down to copper, look at copper. The thing just went straight up. Oh, man. I mean, we had bullish expectations. I was just saying, yeah, this thing's going to go up. I don't know how much, but no way you could have set that sort of expectation. Look at how high that thing has gone. The metal has gained more than 10% since the middle of February. Chinese smelters are grappling with reduced treatment and refining fees. Fees earned for transforming concentrate metal, concentrate from, sludge that the mines provide to the refiners into an actual metal, while also having to deal with supply disruptions in international mines and increased capacity at domestic rivals. So we could see the supply of copper kind of get restrained a bit in China. Not looking great. Yeah, key Chinese copper smelters are poised to deliberate pretty shortly here on their production strategies in an upcoming quarterly meeting, spurred by that significant downturn in processing fees. I think, oh yeah, here it is. Typically, smelters charged $60 to $80 a ton, and now it's dropped down to about $10 a ton. So now they're going to have a meeting to raise this fee per ton higher, and it's going to make copper cost a lot more. Oh, and they're also going to cut back on how much material they will treat. So not only are they going to charge miners more to get their material smelted, but they're also going to take in less tonnage. At least that's what's being speculated here going into this quarterly deliberation of Chinese copper smelters. So you have that with this catalyst here of services falling, giving manufacturing a relative movement higher, right? When services go down and manufacturing goes up, like it did this week. Remember, on Monday we had manufacturing in the United States bump higher, and today we saw services in the US also go lower. And that's generally been the trend around the world. So now you're seeing relative outperformance in a lot of manufacturing areas vis-a-vis people been talking about how crazy commodity prices have just been going up into the right. I mean, that's gold, that's silver, palladium or platinum, copper, iron ore. I mean, is that correct? I thought iron. Yeah, this is correct. Yeah, iron ore is down here. Everything except for iron ore, and that might not be super easy to see. So here's a line chart. Iron ore is at $100 a ton in China right now. This is not good. Uh, Australia is particularly upset about this. Australia and Brazil, frankly, are particularly upset about this. So when we take all this stuff into consideration with this relative strength in manufacturing and how it's putting more upside pressure on commodities. I mean, nat gas is holding up, it looks like, which is actually pretty good for Europe. But the commodity side of oil and gasoline for the United States is not it's not a good sign for the next CPI. I've said for about the last week that I expect the next CPI to be higher. So even if we're still getting good employment figures and we see, let's say, some weaker dollar action over like the first couple weeks here of April, which was our original expectation here going into April at the end of March. Well, now that we're in March, if we get the weakness into the middle of April, when we're getting the CPI here, if the CPI accelerates past expectations, it's going to immediately reverse. Like the if we have a risk on first 2 weeks here and a lot of assets, a reacceleration in CPI is going to almost immediately cut off a third to a half of that run almost because it's going to keep the Fed higher for longer relative to the rest of the world's central banks, which will make the US dollar more expensive, which will put a cap on just the monetary appreciation. So a lot of these risk on trades might still continue going up, like we're seeing with gold at the moment. And I'll get out of a line. Gold is just moving exponential here, sideways, exponential here. But going forward, I mean, there might be another week of this, and we head into the higher end of the 20s here, and I'll expand this real quick. Because there is something I want to show you guys. I was kind of playing around with the indicators here on gold. And I went to weekly charts, and I'm like, oh, here's the quarterly ranges. So what this is doing here is it's telling me generally for a given quarter, where do most of the tops come in and where do most of the bottoms come in for a given quarter. And it automatically does this when you bring up weekly charts. So these are weekly bars. This shows gold's price action once a week. And the range here, so from here to here is 1 quarter. You can see 91 days right there. And if you look closely, you'll see we're right here at a peak in this distribution. So you can just visually look at this thing and see all these bumps where most of your highs, or in this case, where you see these bumps, most of your lows occur for a quarter. And so I was looking at this and I'm like, well, maybe it goes a bit higher here, but I'd start to expect some like some resistance to start coming in here more significantly in this $2,300 area. And if we look at things on a yearly range, which I've really never done before, you also have a lot of stuff. So maybe sometime in the next 2-3 months, you see some kind of slowdown. Somewhere here in the high 2300s, potentially high 2400s. There is a chance, cross your fingers, gold bugs, there is a chance of 2600, but you would need really good inflation numbers to come out. Like, you would need this March CPI not just to come in as expected, but you would also need the next several, because right, this we're looking at a monthly chart, so you would need several CPIs not just to come in as expected, but also to have slight underperformances or just outright underperformances drifting lower. And then the Fed can get back not just to doing the 3 rate cuts that are currently priced in, but potentially move in on doing 4 or 5 rate cuts, or potentially doing a 50 basis point rate cut at some point this year. And that sounds super juicy. And that would probably, if the Fed does a 50 basis point rate cut this year, I would not be surprised to see gold at like 2,600 sometime on the year. But most, I think, consensus views are going to be like, okay, somewhere around here, the high for gold is going to come in, and it's probably more or less going to be sometime in the next like 2-3 months. Because once you get into the latter half of the year, equities are going to have slightly better performance. Services is going to make a rebound in the second half of the year. Unless commodities really kind of quote unquote start their super cycle. And if we watch, gold miners and copper miners, if the supply of things is still really tightly constricted, even with inflation coming lower, even with all these good things, let's say, happening at central banks, with them cutting and maybe cutting super aggressively, uh, I mean, it would be hard for there to be a super huge commodity super cycle as inflation is going lower. I mean, wow, check that out. A lot of highs here for the year on oil. That is nutty. It's just hard for me to set an expectation of, lower inflation and stronger oil unless supply is just super tightly constrained. Because as inflation goes lower, you're gonna need to constrain supply even more. And that's gonna be hard because wasn't there just a major country that got into fights with Venezuela? I forget what the name of the country is, but they're bringing on line like uh, more than 1 million barrels. I forget what the metric is, maybe a month. Like there's a particular country that's doing especially well as a huge oil producer, and they're actually out producing a lot of OPEC members now. Like in the next year or two, it's going to be a huge deal, and it's going to suppress the price of oil considerably unless they end up joining OPEC too. But it seems like the United States is kind of protecting them at the moment, especially from Venezuela. So I think the head of that country recently went viral on Twitter for ripping out some British guy, telling him, "Oh, he needs to be more environmentally conscious." And the guy's like, "You guys didn't care about us until we found all this oil. Yet, in the years leading up to finding this oil, we've been taking care of one of the world's largest rainforests that produce a lot of the world's oxygen. So don't you go telling us and lecturing us about the environment, because all of our carbon credit is already offset by the decades and decades, and the future decades of time will be taking care of our rainforests." And I thought it was just such a good comeback. Like, obviously, yeah, obviously great commentary. Okay, March CPI stalled progress on headline, but slight progress on core. So Wells Fargo is just expecting sticky CPI for the March CPI reported here in April, but still expecting some improvement on the core numbers, essentially similar to what happened in February. And this is what things look like so far on the CPI. So essentially just flat, 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 flat. PPI food versus CPI food at home. CPI food at home. I mean, dude, this is still freaking expensive. So many people complaining about food, rightfully so. By the way, it's just. I mean, goodbye dollar menu. The dollar menu hasn't been a thing for a long time now. A long time now. Goodbye sub $1 candy bars and whatnot. Even when you go to the Dollar Tree or the Dollar General or any dollar store, there's always asterisks on every single little pricing thing because not everything there is always actually a dollar. Some things they sell. They'll sell you some stuff that's not a dollar. And that never used to be the case really. So but they have all these little asterisks around. Let's see here, excluding housing, core services inflation likely picked up in March. Again, excluding housing, which is the largest component, one of the most important components of service inflation. And they're saying it likely expanded, as well as gasoline prices, right? I think that's HG. No, that's copper. Gasoline is RB. So this is gasoline. And you can see gasoline. Gasoline has been doing what gasoline does. And pretty much from here to here, gasoline's up 10%. No duh, that's going to rise. So on top of housing, on top of gasoline, and if you, at least on the United States front, there's a report that comes out from one of the government institutions in the United States related to energy. I forget exactly which one it is. But every single week they send out an email saying what's kind of the median or average price that people are paying in one of 7 different PAD regions for gasoline. And I think except for like 2 or 3 of the regions, mostly it's West Coast regions that are seeing the prices increase for their gasoline, but their prices in the other regions that are decreasing or remaining flat are like 2, 3, 4, 5 cent decreases. Not really big decreases, while the West Coast is still seeing five. It just recently saw like a 10, 15 cent increase in the price of gasoline, per gallon. It's really not looking good. The rate of change of prices net across the board in the United States, at least for gas and for housing, is not looking particularly great. Yeah, see this outlook. Services need to run with the disinflation baton. We expect inflation to move lower throughout the year, but progress will be more of a grind ahead. Slower growth in goods prices have accounted for half of the decline in CPI over the past year. And CPI has been so when we look at this chart here, way up here. So when you see this decline, most of this decline started getting sticky around here, and this is when the services stopped moving. So all these little dips and drops since pretty much here, right? Right at the tail end here, so about a year ago, that's when the goods started becoming the more significant factor for keeping inflation lower. Supply chain strains are no longer easing, even before the latest logistical challenges stemming from the conflict in the Red Sea and the collapse of the Key Bridge in Baltimore. Supply chain pressures, according to the New York Fed's barometer, have returned to roughly neutral stance. We expect inflation to move lower throughout the year, but progress will be more of a grind ahead. Yeah. Oh, that is a great chart. That is a great, great, great little chart. Here, let me copy paste this thing over here so you guys can see it super clear. Check that out. So the blue is the services component of CPI, and the red is goods. So you can see goods inflation post COVID took off like a rocket, and then it fell down to around here. Services started to fall only around here. So what, call that 6-8 months later after the peak in goods. And now services inflation, I mean, I gotta zoom in even more on this. Oh, 1 second. We're going with the Jumbotron here. Jumbo. So again, blue is services, red is goods. So when Wells Fargo is saying, hey, most of the disinflation recently has been from goods, it's because we had this uptick in goods inflation right around here. And now that uptick is now pretty much gone. And you can see that the services inflation has just stayed flat this whole period of time except for right over here. So that's not good. Services just is not budging. And there's a potential for a reacceleration. The potential for reacceleration again comes from oil, gas, and housing, and actually, frankly, a lot of food prices. Oh, and also if you're seeing employment rise, remember, oh God, I think I might have it somewhere around here. That what was it when if you were, instead of going from unemployed to having a job, if you were just going to a new promotion or switching jobs, you got like a 10% pay increase on average or on median. Man, I wish I could pull that up. Yeah, we believe core goods prices have further room to fall. So maybe goods prices becomes more disinflationary, but again, the headline here is services really need to pick up the pace for the Fed to start actually doing something. The Fed's not going to do anything if things stay sticky, 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 sticky. Oh man, and with the risks of higher of a reinflation bout here over the next month or two from the higher manufacturing costs, right? The one of the reasons these manufacturing improvements are coming is, well, hey, we can all these people are starting to become more profitable. All these oil and gas and gold miners who do all this manufacturing. Oh man, oh man. Let's see here. With goods disinflation petering out over the course of this year, services inflation will need to slow further to keep up inflation on downward path. And this is the calendar up. Inflation rate for Europe. This came out lower. This was really, really, really good for Europe. It means that they are likely to cut. But here's the problem. While this number was good, if you look at the European side of things, it didn't move their yields. So while the inflation rate improved, if the inflation rate doesn't improve in the United States side of things coming up here in about another week or two, I believe, if the inflation side doesn't improve here on the US side as well, the euro's not going to go past 109 here. Now, don't get me wrong, our nominal expectation was to see some sort of up move, was nominally to see some improvement, but remember, this is the closing odds right around here. right? Most closes are around here. And if we look at our indicator over here for seasonal closing data, it's roughly around this area here. So unless you're expecting us to close way up here at 109 for whatever reason, let's assume, for example, that the NFP numbers came out really, really, really good. Oh yeah, see here's the ISM service prices. Yeah, that's the big thing that moved stuff. Let's see here. Powell's speech. Okay. Oh Lord. And now you're having all of these services PMIs coming out for the Eurozone here shortly. Consensus is for them to also rise. So yeah, if these PMIs here, composite and services PMIs, if these continue to rise, oh yeah, going up here seems more likely now. Again, is this is is this gonna happen? We'll see. I have good hope on the composite side of things across all these countries, but I'm not so sure how services is gonna hold up. My one cross my fingers hope for a more bullish euro is that, for example, this French PMI, see how it's expected to really jump high. See how it's like, oh man, this thing's gonna jump all the way to 49.8 from 48.3 on the services side. My hope is that this thing gets above 50. If this thing can get above 50, that'd be, French kiss. That'd be so good. Chef's kiss. That'd be so, so good. And then the PMIs out of the UK are also doing pretty good as well. Let's see here. Jobless claims, continuing jobless claims. Let's see here. NFP here on Friday. Canadian employment non-farm payrolls. So non-farm payrolls are expected to fall, but this isn't necessarily bad. This is kind of like Buzz Lightyear falling in style, where you're going back to a historical normal. Because remember, since COVID, a lot of economic data has been performing way above historical averages. So just because it's falling doesn't mean that it's necessarily doing bad. It just means that all of this recovery that's going on since COVID means the economic numbers are starting to turn more nominal. It doesn't necessarily mean that the economy is slowing down and grinding lower and that it's bearish. It just means things are more or less returning back to what the economy should be leveling out to experience more nominal growth over a longer period of time. So, net, this would be good to see, but would be more interesting is actually any revisions, any NFP revisions. So if the NFP revisions are lower, again, same thing with the CPI figures. If the CPI gets revised higher or lower, because, oh my God, the revisions have been crazy on a lot of these economic indicators too. So we'll move on to the next thing. Just, hey, it's not enough just to look at these headline figures. You also got to look at the revisions. And as far as Europe goes, it looks like those PMIs are going to turn out really well. So actually, I would not be surprised to see us trade up here, actually, at the 109. Now that I know that the PMIs are right on our tail here. Right here. All these PMIs. Yeah. If these turn out good, if we actually get close to those consensus numbers or past them in a couple of senses here, we could end up here uh, pretty much immediately. And that would reverse these negative yield spreads, I think. So, I mean, actually, no, I don't think this going up would reverse the negative yield spreads because the United States would still have really high, tight monetary policy. So you'd see negative yield spreads, but kind of what you're getting here, which is negative yield spreads, but more improvement. It just means that the growth side of things is outperforming the carry cost. Because right now, if you were to sell euro dollar, you'd get positive carry because you get more interest for holding US dollar and US denominated assets. But in this case, the Eurozone is now actually economically recovering, and positive numbers out of this would further put pressure on that claim, saying, yeah, we are actually growing. The economy is kind of getting back on its feet here. If these numbers come out good too, well, sure, you got negative yields, but it just means that the growth is outperforming the negative pressure from these yields. And hopefully that carries over and we see that in the US data, and then these yields will actually fall lower, and then we'll start to get some positive carry on the euro side of things, and we'll start to see some situations like this where positive yields on the European side of things and positive growth on the European side of things, right? Negative yields on the euro side of things, negative growth on the euro side of things. And so far, I'd say expectations have certainly been a bit mixed this week. We've kind of hit both of these plans where we went down here, down a little bit here, and now we're going back into the nominal trade plan. So I was thinking, hey, probably some bearish continuation from this point, but thank God the economic data is actually improving. We just need the services side of inflation to actually start coming down to see more follow through on this stuff. And I'm going to bring up Disney real quick because this is kind of in the news here. So, Disney is right now in a very complicated battle. This guy, Nelson Peltz, they want a seat at the board of Disney, and they want to be able to kick out Bob Iger and essentially kick out all these woke people at Disney because it's costing Disney a lot of money to create all these shows. And I mean, what was it? 2 of the Star Wars movies had to be reshot endless amounts of times. They had multiple different endings. And that's kind of the same thing with a lot of these shows that are on Disney Plus. They have to shoot multiple times, multiple endings. There was recently a particular actor that apparently on set got really, really mad at a lot of people because he was acting out a scene without a script, and it had not been the first time. And apparently, what they were doing is they were shooting scenes with no script, so then they would just have footage for footage's sake. And the actor's like, this is a huge waste of time. Why am I here? If you guys aren't ready to film the damn movie or film the damn show. So, I mean, and then how they totally, boofed the Mandalorian show, and no one thinks very highly of Disney right now as far as the quality of their entertainment goes. And stuff like this that says, hey, Disney beat Nelson Peltz in the shareholder vote. This, while it can be true, read this section here. Shareholders threw their support behind Iger, with the CEO securing 94% of votes cast, while Disney director Maria Elena, I'm not going to say that, whose seat train, yeah, contested, they won 63% of the vote, according to people familiar. This pissed off a lot of people. And also, Reuters came out saying, hey, people familiar with the matter say that Iger has enough votes. People are pissed off. One of them is Bill Ackman. Huge mega thread here talking about, hey, if Peltz were actually winning the vote, why are people from inside Disney leaking to the press that they're winning the vote? Because doing that interferes in the voting process. If you tell people who are voting in any process, hey, the other side is winning, so don't even bother going to vote because they have essentially already won. They have enough votes to keep Bob Iger in place. Well, then why bother even voting at all? So now Bill Ackman and a huge assortment of other guys are saying, hey, SEC, you need to do an investigation of why these leaks occurred and potentially commence a second vote. Here, the company and or its advisors have leaked the early results in order to tip more institutions and other shareholders to vote for the incumbent board, unfairly tipping the scale in the incumbent board's favor. In other words, any institution may think if Peltz is going to lose, it is not worth taking the risk of offending management by voting for him. So these early leaks have, even if it was all done legitimately and the leaks were just done because someone thought, oh, the public should know what is going on early. It's created a huge foothold for these guys backing Nelson Peltz to say, no, we want this investigated. We want to redo. These leaks have thrown off the vote. So it's given them a bunch of legal ammo, and the SEC is probably actually going to take a look at it, given all of the eyes and all the money that's on this. Yeah, I had a couple other things that I wanted to go over, but they're really not that important, to be frank. They're quite minor things. This is a midweek stream, so there's not much to update as far as the chart, to be honest. I'm just gonna quickly run through these things. Hey, look, we hit our expectation. Hey, look, we didn't necessarily hit the expectation, but we were directionally correct. Hey, look, we didn't set an expectation, but it looks like we're gonna be closing similar. And then pound, yeah, looks like we're moving in the nominal expectation. This thing definitely overshot. Euro dollar, moving it overshot, but still going back into the nominal expectation. New Zealand also doing well. It doesn't look like the bank, the Ministry of Finance, is actually going to be doing anything here. If I go to dollar yen, it's like, hey, so long the dollar yen doesn't move, all these other yen pairs can continue to move. So you got that going for it. Euro yen also going bananas right now. Likely to close up here at these spots. Euro CAD holding up, likely to close higher up here. So I'll go ahead and draw an expectation of a close up here. Blue. April the 3rd up here. And let's see here. Euro pound. This looks like it's finally going to roll over at this point. So I'm going to put my expectation down to here. And it also looks bearish into next week as well. See that? And dollar CAD moving as expected. And technically, yeah, the DXY moving as expected. Let's see here. And Bitcoin's holding up. It's after its dump over here, it's holding on. It's holding on for dear life. All right, you guys. With that all said, I'll go ahead and call it. Stream's been going on for an hour. So thank you all for watching, and I'll see you all in a bit.